$780 a month for a new BMW sounds affordable, right? By the time you are done, you will have handed over $62,000 for a car that cost $45,000, and you will not even notice until it is too late. This is the 7-year car loan trap. How did car payments shift from 36 months to 84 months, quietly draining billions of dollars from Americans? The answer begins with a single shocking transaction. A buyer walks into a dealership eyeing a brand new BMW 3 Series with a price tag of $45,000. The salesperson does not talk about the total cost. Instead, the conversation zeroes in on one number: $780 a month. That is the payment for an 84-month loan, 7 years. The buyer runs the math in their head. $780 feels manageable, especially for a luxury car. The paperwork gets signed, the keys change hands, but the real price is only just beginning to reveal itself. Over the next 7 years, that $780 a month adds up to more than $65,000, including interest and fees. The car itself never changed. It was still worth $45,000 the day it left the lot. But the loan quietly grows with every payment. No one at the dealership mentions that $20,000 of that total is pure interest, money that goes straight to the lender. No one points out that after 3 years, the BMW will be worth about $28,000, while the buyer still owes nearly $35,000. The buyer thought they were stretching their budget to get a nicer car. Instead, they locked themselves into a deal that drains their finances for most of a decade. This is not just a bad deal, it is a trap, and it is set by design. 20 years ago, a new car loan usually meant 3 years of payments. Today, the average now stretches to nearly 6 years, 68 months. 7-year loans, once unthinkable, now make up over 1 in 5 new car deals. At the heart of this trend is a price explosion. The average new car now costs more than $50,000. As prices soared, buyers searching for relief found it in longer and longer loans. The solution seemed simple: extend the term, shrink the monthly bill. What started as a rare exception became routine. By 2025, 84-month loans are everywhere, pitched as the only way to afford a new vehicle. Dealers and lenders present these terms as normal, even responsible. Yet every extra year tacked onto a loan adds thousands in interest and delays any chance of building equity. A market analyst puts it bluntly: 5-year loans used to be the standard. Now 7 years adds thousands more in interest just to make the payment fit. What was once a financial red flag is now the default for millions. This normalization did not happen by accident. It is the result of a system built to stretch buyers to the breaking point, all while making the numbers look safe on paper. Dealership tables are covered in paperwork, but one sheet matters more than any other: the 4-square worksheet. This tool splits the deal into 4 boxes: vehicle price, trade-in value, down payment, and monthly payment. The salesperson never fills it out in a straight line. Instead, numbers get circled, crossed out, rewritten, and flipped back and forth. Every change distracts from the real question: how much is this car actually costing you? A former finance manager described the process as a game of misdirection. We would ask, what monthly payment are you comfortable with? That number becomes the anchor. From there, they stretch the term, add gap insurance, maybe an extended warranty, whatever keeps the payment low but pushes the total higher. The worksheet is designed to keep buyers focused on the monthly number, not the loan's total size or the interest rate. If a buyer pushes back on price, the salesperson shifts the conversation to the trade-in. If the trade-in is too low, they bump the down payment. Each quadrant becomes a lever, and the only goal is to get a signature at a payment that feels safe. Behind the scenes, longer loan terms open the door to bigger commissions. Dealerships earn a cut called the dealer reserve by marking up the interest rate and stretching out the loan. The more months added, the larger the reserve and the bigger the bonus for the finance office. One whistleblower put it simply: the only lever that matters is the term. If you can stretch it, you win. This system is not about helping buyers afford a car, it is about maximizing profit by making the math too confusing to follow. The worksheet is just the start, the real manipulation happens in the mind. salespeople know exactly how to keep buyers from facing the true cost. The conversation always circles back to one question: what can you handle each month? That single number becomes a shield against discomfort. People are wired to avoid immediate pain, and a high monthly payment feels like a punch in the gut. So when the dealer suggests, for just $40 more per month, you can get the luxury package, leather seats, navigation, the works, it feels like a small treat, not a trap. But $40 a month over 84 months is $3,360. Enough to buy a used car outright. That is just one upsell. Add in gap insurance, tyre protection, or a fancier sound system, and the payment barely budges. The total, though, grows by thousands. Behavioural economists call this the pain of paying. The brain is quick to trade long-term loss for short-term comfort, especially when the math is hidden behind layers of paperwork. Buyers rarely stop to ask, how much will this cost in the end? The dealer worksheet is designed to keep that question buried. Every add-on, every extra feature is packaged as a harmless bump in the monthly bill, but each one compounds, quietly turning a manageable payment into a mountain of debt. The real danger is not just in the numbers, it is in the way the system exploits how people think, nudging them toward decisions that feel painless now, but lead to years of financial regret. Stretching a car loan from 4 to 7 years transforms a simple purchase into a financial time bomb. On a loan of $45,000 at a 7.5% annual percentage rate, a 48-month term racks up about $6,400 in interest. Extend that to 84 months, and interest balloons to more than $12,500, nearly double for choosing a longer term. That is $6,000 flying out the window with nothing to show for it but extra years of debt. Meanwhile, the car's value plummets. New vehicles lose 20% the moment they leave the lot, then another 15% in year 2. By year 3, that $45,000 car is worth about $28,000. Yet the loan balance barely budges. After 3 years, most buyers still owe $35,000 or more. The math is brutal. You are underwater by $7,000 to $10,000, trapped in a loan that has outpaced the car's value. For many, there is no way out except to keep paying and hope nothing goes wrong. The pain isn't spread evenly. For buyers with shaky credit or tight budgets, the 7-year loan can be devastating. Subprime borrowers with credit scores below 620 are steered toward the longest terms and the highest rates. These loans are pitched as a path to rebuilding credit, but the reality is far harsher. Default rates in this group run as high as 25 to 30%, trapping families in cycles of repossession and ruined credit. The risk does not stop at the loan paperwork. Most factory warranties expire after 3 years or 36,000 miles, and powertrain coverage typically ends at 5 years. That leaves 2 or more years of payments with no safety net. A failed transmission or engine can mean $3,000 to $5,000 in repairs, while the owner still owes $20,000 or more on the car. For many, that single repair is enough to tip the balance from barely scraping by to total financial collapse. The system targets those least able to weather a setback, turning a basic need into a long-term liability. Right now, Americans owe over $1.6 trillion in auto debt, more than ever before. As loan terms stretch and delinquencies rise, every signature locks in years of risk. The next time a payment feels easy, remember what's hidden in the fine print can shape your finances for a decade. Share your thoughts below.